Hello folks, I'm LA Little and this is your daily NeoTA wrap. We take a look at these markets, we do it from a neoclassical perspective, each time asking ourselves what happened today, what does it tell us about the coming ones. I do this show 4 times a week, every Monday through Thursday. It's broadcast at or before 10 o'clock Eastern Time. It's archived on YouTube. It's under the channel LA Little. As far as what happened today, we got a big pushback the other way. Last night we were thinking that might be the case. We had some subtle signs that seemed to indicate that. This Russell actually has a bad quote on it. It was up just like the others, anywhere from 1.5%, 2%, almost 3% on the NDX. So you had a big day up. Apple, the other big caps got rolling. And tonight it's a tougher call. You've had some really clean signals for about 2 weeks now, and those signals, if you've been watching the broadcast, those signals have been fairly clean and given us pretty good heads up on what was taking place out here. But tonight they look like they're getting a little bit more difficult to read. We'll try to do our best and see what we got. Elsewhere, you had bonds down full point. You had dollar up about 0.5%, and kind of mixed elsewhere. Not much else going on. As we flip to the charts here and take a look at the S&P 500. So we've talked about the idea that we could get an ABCD structure to the upside, and that's still potentially possible. If we start at the bottom, you have a B point up there. Potentially last night was the C, and you're heading back up. You're right. You're going to try to do an ABCD structure on the way up, and if you do it, it takes you right up to the way it's laid out now. It takes you right up to the bearish retest regen zone. And what that means is you come back to the point of the crime, right, where things broke down, which is here, and you retest. You see if you can get back up there, if buyers are willing to buy at those prices or not. And if they're not, right, then this whole spill that got started to the downside really isn't over, right? This breakdown here in this area, if you came back up there and you're unable to get over it, right, unable to get above the high of the low that was broken, it gives you a fairly good indication that you're going to take it right back down. You're going to try to break out the bottom, because it's all about price discovery, and discovery happens in areas of significance, and significant area is this particular area. So that's potentially what's setting up the ABCD structure here, potentially setting up. But don't lose sight of the fact that today, all you have today is an inside day, right? It's just inside. The bars, top and bottom, inside yesterday's wide price spread bar to the downside. So you can't go get too excited here about what you see when it's an inside bar. This just doesn't tell you much. If you look at the NASDAQ, where you had, actually the index had the largest bounce, but the NASDAQ, you come into an area, you find support, right? You flip back around, you're going to try to do an ABCD structure to the upside. But again, here, just like on the S&P 500, you've got the possibility of a break to the top side, right, on an ABCD structure. So there's no difference there. And what's different here, of course, is that it would take you over the top of this bearish retest regenerate in terms of the projection. That's a difference. The other big difference today is that this thing actually gets over yesterday's bar. And if you want to be very specific about it, it actually did not get over it, in the sense that it was a gap down, so the bar really starts right there, right? And so in a technical sense, you actually didn't quite get over yesterday's bar, right? Even though it looks like it on the chart, you've got a gap that you're getting back into. So to try to make it a little bit more clear, if I were to draw in this bar as it was yesterday, it really was like that, right? From that low down to here. Today, you're inside that bar. NDX looks about the same. NDX pushes back up into the gap area as well, closes over yesterday's top of the bar not counting the gap. So, I mean, those are positive when you do that, but your technical is still inside, and here you're inside as well. So all the major indexes basically set up the same way, not really telling you a whole lot. Now, last night, one of the things that drove us to think that we would turn today, and I told you specifically that Europe probably would be trading higher by the time we got started, and that in fact is what happened. Because the U.S. markets are so tied to Europe, Europe trading higher today, even though it wasn't by much, a third of a percent here on the DAX, after a pullback, came into this bar last night, the night before, and got back over it and held it. So in other words, sellers weren't willing to sell at lower prices over a bar of significance. But today's bar is actually a little disappointing because today the top is 101.2227. Yesterday was 101.1953. So you get over it, you close back underneath it, you have less volume, and you have the ECB meeting tomorrow, which is going to have an effect on these markets. Now, this isn't a strong signal, but it's a little hint that we may have some issues out of Europe tomorrow. And if we look at the CACs, it's set up exactly the same way, did exactly the same thing. Now, the good part about them is they both held outside this bar. They didn't close back in it. Right? For example, here it's 45.40, and the closure today was 45.54. So, it's not all that negative, but again, it's not as strong a signal as a result of the over-under. In Hong Kong, it looks like you're finally ready for a bounce. You get under the low, back over it, less volume, so you're testing. Sellers unwilling to sell at lower prices. It's going to flip around, try to go back the other way. And the Nikkei heads down, right, gets close to the bottom, doesn't quite test it, but does hold price. Looks to me like this one's also going to try to bounce. So before doing anything else, I want to take a couple questions here from a viewer, and then we'll come back and we'll do the final wrap. So one of the viewer questions has to do with the qualified trend on the weekly on the S&P 500. And it shows as, and I'm a little confused by the question, and maybe there was a misprint or something at the beginning here, but this shows as a suspect break, and the question was why it is show as a confirmed break. Red, you can change these colors, but red on my charts is suspect, green confirmed. So it closes under, and matter of fact, it was a break of 4 swing point lows all at one time, which is kind of abnormal. I've got a colleague that's looked at this and said this is the first time in history it happened all on one bar. But those breaks, when they take place, just to use this question as a means of answering maybe another question, which is, as it takes place, they take order of precedence on the way down. So, the first one you check with is here. It was suspect bullish at the time of this break. That would make it sideways, and the volumes would have been, make it either confirmed or sideways. Confirmed or suspect. The next one is this one, but since it broke 4, you wouldn't stop with that one. That would have turned it bearish. This would reaffirm the bearish, and this would reaffirm it again. Because the volumes over here, of course, is the last one that we're comparing to when we draw the final trend, the qualified trend. Volume here, of course, a lot heavier than volume there. That's what makes it suspect. That's why it ends up being suspect here on the charts. So maybe there was some confusion. Maybe there was a missed signal here at the beginning or something. But yes, it is suspect, which is what the viewer thought it should be. I guess that answers the question and hopefully gives a little color to the rest of the idea behind how these things get formed. The other question has to do with some of these, they called them flash crashes the last time they happened. Now they're calling them mini crashes, or at least that was the term I used. Because they didn't crash like they did back in May of 2010, but they certainly spiked down some abnormal amounts this time around. You know, if we take Verizon for example, the day before Verizon traded at 46.10 was the close, and then on the 24th, that big drop on Monday about a week and a half ago, it traded as low as 38. So from 38 to 42, excuse me, 46, that's roughly $8. $8 on a $46 move, $46 stock is roughly, you know, I don't know, 18% or something. It's huge, and it all happened within a few minutes. And so what it's done is it's really messed up the charts in that you have this huge volume, you have a huge spike down, right? And the question is, you know, is that a magnet? Is it going to pull prices lower? Well, maybe in due time it will, but given the abnormality of this move, I suspect it's going to take time before that happens. I would just pull it back to a weekly and see what the weeklies look like, and then also on a monthly and see what they look like. And if I do that, right, I have pretty good volume here, but that volume, and we can just do the numbers, that volume is about 126. If I look over at previous lows, you know, volume, high volumes, here's 130, and then these two back here are 139, and this one is 121. So essentially you went under all of those. In other words, you tested all of these on this time frame. So we have a test, you know, of these where the volumes are up here. We have a test of this area with a volume there, right? And we test it with this much volume, and in every case this one has less volume. So that's a successful test of the lows on a weekly time frame, and that suggests that sellers are unwilling to continue to sell at the lower prices. And that kind of reflects the abnormality of what just happened. And so I think, yeah, it kind of screws up the charts and makes them kind of dumb, right? Because now this is going to end up being a swing point low, which will take forever to get closed, or, you know, to close under it if it ever does. And so what will happen is it will take, you know, 60, 70 bars before this chart becomes a little bit more normal. You know, because there's 60 bars to a chart, it will have to fade off the left side before we can actually get better reads on the lows. Because now you're probably not going to break that low in 60 bars, would be my guess. So in 60 bars in this case is 60 weeks, right? So in the case of Verizon, you know, what you have now is you have a test held. That tells you that it's probably not going to go down and revisit those lows because nobody was willing to continue to sell at those lows. So that's how I would read that.
Do you have retirement funds you want to keep invested, yet you constantly worry about a potential market crash? As LA says, you shouldn't worry about a crash until it's time. Through LA's extensive research, he has identified the key characteristics that are necessary for a market crash. In the 2008 crash, for example, our investors actually made money and avoided huge losses through LA's investment advice. Because the markets usually go up, our retirement service keeps you invested when risk is low and reduces your exposure when risks become elevated. There are 3 portfolios you can follow: aggressive, balanced, and conservative. It's a simple process at a reasonable cost that requires very little of your time. To learn more, go to our homepage, hover over Retirement Service, and click Get Started.
So as we come back here and you know, do the final wrap, I've got it on a weekly time frame, and you know, essentially what's taking place right now is a lot of choppy trading that's tied to this huge break that took place. And on a weekly chart, you know, this thing can trade back up all the way to that 2070 mark if it wants to. And it could still be, at that point, it could still be a downtrend, right? You've already changed here to a downtrend by qualifying the trend as suspect bearish. You would have to get above a swing point high in order to change that trend. And at this point, that swing point high is going to print right here in another bar. So in other words, you got to get over the tops. But until you either, take the time to build out this area and create another swing point high at a lower level, and then eventually get over it, right? You're going to have a bearish trend in effect. And that bearish trend is probably going to play out, and it's going to play out for some time as a result of that. So if I look at this on a weekly, we're probably going to continue in this big range now that's been developing or is starting to develop for some period of time. And if you draw the range out, it looks something like this. So the tests are going to be at the tops and bottoms of the ranges. One of them's right here. That's what we tested today, held. The other one's up here. That's the bearish retest regen on the weekly. It's getting into these sets. And so, this, to me, the overlap here on the weekly complements, this area right here complements what you see on the daily chart. If I drag that across, what's on the daily chart that I'm saying it complements is this bearish retest regen zone. So if we do, in fact, get this bounce, you can see how that area is going to be a huge hurdle to get back over. And even this projection just takes you right to it. As far as tomorrow, the next day, you've got the ECB tomorrow, you got the employment numbers on Friday, you got Labor Day on Monday. It's going to be hard in this market to get too bullish, but it's also going to get hard to get too bearish. The result of that is that you're probably going to chop around because of it. And so you're going to see this market chopping around in whatever the area is here, back and forth for a while. It's just going to have to play out that way. That's just the way it's going to form. And so if you think about it from that perspective, we're talking about large point ranges. There's going to be a lot of up and down probably for the next week or two until we get out to that Fed meeting, or until somebody signals us that they're not going to raise rates. And I don't think they're going to signal it until we get to the meeting. And so I think you're going to have a lot of uncertainty over the next couple of weeks, and that's going to keep this market from moving too far one way or the other. And when I say too far, it's a relative term. I'm talking about, too far in the sense that you're not going to go, back to new highs, and you're probably not going to go back to new lows. You're going to stay somewhere in this big box, in this big range. That's what it's done. That's probably what it's going to continue to do. The trades are inside the range, up to the top, down to the bottom. It probably plays out for a few weeks, at least, another week or two. It could go on for longer than that, though, especially given what's just happened. And it's going to be this huge range. And that's a playable range if you want to play it. As far as a long-term investor, it doesn't do much for you. Either you're holding on and hoping that this isn't the big one, or you're, holding on, hoping you can average in lower, which is what I hear a lot of people always say. I'm going to leave it at that. So no good signals for tomorrow. If anything, I have a slight bias probably to the upside, but it's not a strong signal. Have a great night. Thanks for joining me. Tell a friend, tell two. I'm LA. This is and was your daily NeoTA wrap. Take care. Good night.